I want to just go through this concept so people get this. If you take a look at the bond market, the dollar, and the S&P, you should be looking at this during economic events. Even if you're day trading, you should be looking at this. And I just want to go over this concept again, and then I will take questions on only this concept, and then I will answer another question. But in front of us, in this little blue, light blue line, you have the S&P. Then you have the dollar, and then you have the bond market, the yield. Why this is important is when economic data is released, that allows us to know the action that the bond market is taking. And the bond market and the reaction to the bond market is the most critical thing for when economic data is released, because they are expecting either rate cuts or rate hikes or movement based upon a percentage chance of a rate cut or a rate hike. That's why this is so important. That tells you the move. So even if we read the data and we think the data is good or bad, our interpretation of that data does not matter. What we think of that data does not matter. We might think it's super bad. We might think it's super good. The bond market is going to tell you where people are. It's going to show you the sentiment of the underlying market. So if you have economic data and it's hot, meaning worse than expected, and that data that's worse than expected leads to a move where you go and you see bond buying, well, that might mean that the sentiment has changed. And that's how you have to look at it. For example, when we just recently had two core events that were very different in action, and you can see those movements, I'm going to mark them off here. But if you see what happened right around this time frame at 9:45, and you're just going to see what happened here Friday at 10 o'clock, and we're just going to pay attention to this. And this is the break, obviously, before that market opens again. But if we take a look here, this economic data was really very, significant. And we actually sold off, meaning they sold bonds because they expected the yield to go higher. Why? Because rates were going to stay higher for longer. Therefore, they don't want to own bonds. So they sell bonds, they buy the dollar when they sell bonds, and they sell equities. They sell bonds, they buy the dollar, and they sell equities. Now, the important part of this is that you want to see that they're selling equities at the same time. They always will. And the first move is always the bond market. The dollar's in there just so you can guide that. But really, you're looking for this particular part of it. Okay? That part becomes a lot clearer if you don't have the dollar in. I put the dollar in just as a secondary indicator. So I put the dollar in as a secondary indicator, but you can look at the chart that way, and that might be cleaner for some people. For me, having the dollar in there is just another demarcation line that I'm not seeing a false positive or false negative move, that I'm seeing the true move. So that's why I have it in there. And also because they're all correlated. So when you see the sell-off, you know that this is probably going to continue. You're looking for the movement on the economic data. This is very important. At the end of the day, you could have something else said by like a Fed chairman, like we had in here, that leads to more selling in the equity markets, or a Fed speaker here. That doesn't mean that the bond market's going to react the same way to it. And that is a completely different conversation. But for our purposes, what we want to do when economic data is coming out and we're day trading, I don't care if you're day trading a company that sells Fruit Loops. It does not matter. Everything is going to move predicated upon this, because this is going to change the whole equity risk premium on a very small scale. So whether you're day trading or swing trading, it doesn't matter. If you're here, you can see the move. So what happened here? More economic data construed as positive for the market. They bought bonds, they sold the dollar, and they bought equities. They bought bonds, they sold the dollar, and they bought equities. And this is a very simple chart that you can look at on a 1 minute, 5 minute basis. I would recommend you look at it on a 1 minute basis. I would recommend that you assign this to a line chart. You can use anything you want, line with markers, steps, anything you like. I find it best to just look at it with a line because it's much clearer on direction when it's set. Because I'm not looking for pricing as much as I'm looking for direction. But this allows you to know what's going on with your trades. So if you're day trading and you see this happen, you know that you probably, in your long, you probably want to get out of the way. As what we did here on Friday, when that happened, we saw that it was positive. We said, okay, we're good. Let's put on some more equities. Let's leave our equities alone and keep moving our stops up. And that strategy worked. Before I go on to any other topic, is there any questions about the dollar, the relation to the 10-year on economic data, and the relation to the S&P, and how to set this chart up? Is there anything about this that anybody wants to go over? Okay, so the question I see in regards to this that is of interest to the topic is, do you want this set up all day? Do I have this set up all day? I don't have this set up. I might be looking at the bond market and the dollar and the movement all day. but I'll click to this. Where I want this set up are two major times. I want this set up when we have major economic data, or that could be even a Fed meeting, right? Or FOMC meeting, that would be economic data, okay? Or if I have a bond auction. So any kind of economic data, whether that's going to be the Fed meeting, Fed minutes, anything like that, or any economic data that's going to be released, I want this. Or a bond auction. Now, if some monetary or fiscal policy change happens in the midday, I will pull this up, but that is extremely rare that Yellen's going to say something or they're going to do an emergency rate cut or rate hike. That's extremely rare, obviously. Then I will pull this up. But economic data such as FOMC meetings, minutes, speeches, Powell speaking, or something of significance like PMI, non-farm payroll, CPI, or a major bond market event, bond auction event. You can use it for the smaller bond auctions, but you really want to use it for the 10-year, the 20-year, the 30-year and see how they react. Just to be clear, yield up. Yep, TNX is yield. So yield up, dollar up, S&P down. Okay. Yield up, dollar up, yield up, dollar up, S&P down. Yield down, meaning they're buying bonds, selling the dollar, equities higher. Any questions, Lise? The bond dollar correlation did not work on Friday. Okay, so let's reclaim that. The bond dollar correlation did not work on Friday. First, when I started this, I said that the dollar is a secondary indicator to the bond market, right? I would argue that it did work on Friday. So if I'm to look at this, and let's get rid of the 10-year for a minute, and let's just look at the bond, let's just look at the dollar correlation in regards to the S&P from the date that came out. So this is the S&P, and that went higher, and the dollar sold down. Now, if we do something as simplistic as just mark that location off with a demarcation line from the time that started, which would be right here, equities are higher, the dollar dropped. So I'm not sure how you're marking that. It is a secondary indicator, but that is how I would mark it. Any other questions, feel free to ask. About the long-term implications of this chart, it is a no-brainer, right? But again, I'm going to remove these drawings. But from a long-term standpoint, it is a no-brainer. If you were to look at this, it is very clear. If we go here and take a look at the dollar, when did the S&P start lifting? Especially if you're balanced. I mean, it's a no-brainer to look at the long-term implications of this chart. That's what was scaring us here. That's why all of a sudden we started going higher. The market started selling off. So there are long-term implications of this chart, and you could use it as such. And if you find the dollar confusing, just remove it. You're better off watching the 10-year. So I used to watch the VIX. The VIX doesn't move the way that people want the VIX to move. The VIX is going to move like the old school VIX used to move because of where interest rates are and Fed funds are. So that's important. So you're better off using the 10-year and you're better off using the dollar. The most correlated moves are point blank are industrials. Nothing will move as industrials. And if it's a long-term structural change, it'll be high beta names that are tech. But nothing moves versus the dollar like industrials. I mean, you can literally set your watch to it. So like if here's XLI, and let's do a different chart to answer this question. But if I go XLI and then I go here and I type in TXY, you'll see usually a pretty high correlation between what's going on there, a declining dollar, and then all of a sudden a bottoming and a rally in industrials. Nothing moves like industrials. Nothing will move like industrials on it. Now, the reason I'm preaching this today and why this is so important is instead of you interpreting the data, let the market interpret the data and then you act on it. We saw a lot of movement on Thursday and Friday, and this told you exactly what was going to happen versus us telling the market what was going to happen. And understanding this allowed us to stay in trades a little bit longer. Commodities would also, but you'll see it in the industrials. If you're selling yield, right? I'll give you the exact opposite trade because I have it in front of me. If you're selling yield, you're buying the dollar, you're buying bonds. So when you're selling yield, right, you're buying bonds, right? So if yield's dropping, what are they doing? Buying bonds, okay? If yield's dropping, they're buying bonds. If yield's rising, they're selling bonds. If yield's dropping, they're buying bonds. If yield's rising, they're selling bonds, okay? If they are buying bonds, they are selling the dollar. If they are buying bonds, they are selling the dollar. If they are buying bonds, they are selling the dollar. They are buying equities. Buying bonds, selling the dollar, buying equities. Buying bonds, selling the dollar, buying equities. Yes. Use it as a secondary indicator, kind of on topic. So let's do it. Industrials sell their goods globally. Industrials sell their goods globally. They are hard assets. Therefore, that hard asset is tied directly to the market, meaning If you sell a tractor, it's much harder to move a tractor than it is software. Hard assets sold overseas are more affected by the dollar, i.e. so are commodities. A pound of sand, a ton of sand, etc. Anything else on this topic?